When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're the show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about what today's market and economy means for retirees and near retirees. Also, is a 60-40 portfolio still dead, or is it just misunderstood? We'll answer listener questions. And finally, are you on track for tax savings in 2026? Did you maximize your retirement contributions last year? My name is Jeff Shea, as always, just here to ask the questions. But the words of wisdom and solid advice, of course, they come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
I'm doing great. Always fun to be with you and the listeners this weekend.
Yeah, me too, Jeff. And certainly we've got a great show lined up for everybody. We appreciate people joining us each and every week here on 790 KNST. Well, today, Jeff, we're talking about what's happening right now in the markets and the economy, and more importantly, what it means for retirees and people within 5 to 10 years of retirement. If someone is retired or close to retirement, Jeff, and they're watching the news right now with market volatility, inflation headlines, and just general uncertainty, what should they really be paying attention to?
I mean, honestly, if they have a plan, they don't really need to be paying attention to anything. They could offload that to their advisor. But if you're trying to figure out markets, good luck with that. Things change in a heartbeat. Right now, we're seeing a lot of momentum. We're seeing some direction with economic improvement. We're seeing earnings on smaller companies getting a little bit better. Wages are staying pretty tight in spite of the fact that we're deporting a lot of our workforce. Maybe that's given a few locals a chance to get jobs. So it seems like economically, we're making some headway. You know, we kind of expected that with Trump, with his business acumen and understanding of how things work. I love how he's using tariffs, and it hasn't really seemed to be hurting our business. It's actually been helping our economy. It's probably hurting European and foreign businesses and China and the like, but that was what it was supposed to do, kind of put us on an even playing field. I think that we can feel a little confident in the market, even though it's overvalued. I still think it needs to correct. Sounds like I'm talking out of both sides of my mouth, but the fact is, the president's bent on keeping the markets strong, and they're working with, these economists that work with the White House are in cahoots with the big banks and the market makers that drive the markets, and they're playing some games to keep it propped up. But while they're doing that, earnings are starting to creep up and make the market not look so outrageously overvalued, even though it's maybe just outrageously overvalued, not really outrageously valued. So maybe we're going in the right direction. I don't think we can hold off a recession, or at least some of the correction periods that we're probably going to need to go through. Early this week, we saw the market open down and it's bouncing around. I think the market started off so well this year that we're probably going to see some pullback. Now, if you're trying to get in the market for the first time right now, I think that you better be really careful. But if you've got profits on the table, there's still a little buffer for those people that are still exposing themselves to the market. I think by and large, depending on where you are in your financial planning stage, you're going to need to do different planning regardless of what you're hearing in the economy. I mean, if you try to time the market based on news and based on who's in office and just say, well, I'm just going to keep throwing everything at the market because Trump made the market go up last time really well. Keep in mind, they printed tons and tons of trillions of dollars during COVID, and people had nothing to do but sit around in their basements or their houses locked up and trade their Robinhood accounts and probably overbuy and get the stock market a little bit out of whack, even though there was only certain companies that were thriving during that period of time. But you talk about the market uncertainty and the news and all the different things that are happening. I think politically, we're getting more and more divided. Who knows? That could cause a lot of civil unrest. We're seeing all the riots and based on the fraud they're catching, and people are all mad. Now they're trying to divert the attention by making these big old ICE protests. And there's just a lot of things that could blow up and maybe derail the market. I think just the fact that there's uncertainty, there's always uncertainty. Remember the cardinal rule number one, and that is don't risk money you can't afford to lose, period. And that was, Lou Dobbs said that in the early 2000s, right after the dot bomb bubble crashed, and he'd kind of been pushed off the to the side because he's out there trying to talk wisdom to the masses and saying, hey, be careful, this market's overvalued. A lot of the big talking heads on Wall Street that people trusted and some still trust, but for those that are still around. But, there are trustworthy voices, and it seems like when the market gets overvalued and they cry caution, you don't hear from them anymore. They're kind of pushed to the side because, of course, they're not speaking to the agenda of Wall Street and profits and their money making. But Wall Street's net selling, hedge funds are net selling. You've got Warren Buffett selling, raising cash. And that pretty much means that they believe that they can buy stock at a lower price soon. So keeping all those things in mind, the economy's doing well, the market's doing well. If you've got some money you can put in there and wait, you might continue to make a little bit of money. Be careful. Make sure that when the market starts looking like it's selling off, go to cash, take a break. You can go to the sidelines. Wall Street doesn't like you doing that because it doesn't fit their model. If everybody jumps to the sidelines when the market gets ugly, their whole inventory goes to zero and they lose money. Wall Street blows up and they get all upset. They'd rather be the ones that scare you out of your stock. You sell it and they keep buying it cheaper and cheaper. That's kind of how their model works. But they want to say most of the people need to buy and hold because it supports their pricing and they can continue to manipulate and do their behind the door games with setting prices and not really caring about more buyers or more sellers. They kind of create what it is in the market. But I think the market's bigger than Wall Street. It will eventually say, we don't care. You can manipulate it so far, but pretty soon it's just going to say, sorry, we're done. And that's kind of what happened in the dot-com. So, Wall Street kept on propping the market up and kept on BSing us into believing that anything with a dot-com was going to the moon and you can make money. And then finally the truth came out that there was a lot of BS manipulation. Merrill Lynch got fined, the biggest fine ever. And at the time, I think it was $500 million, but I think they made $10 billion on the stupid bonds they lied about on WorldCom and Global Crossing and some of the other things that they were selling. I don't think we've gotten quite there yet from the standpoint of just misleading the public into buying securities or getting these bond issues or the way they were creating money back in the dot-com era because the government wasn't just printing it and giving it to the industry. And now that's kind of where they're getting their money. And now they just manipulate it by setting prices and dropping the bids down, causing short sellers to buy and drive the market up. And they kind of understand now the psychology of the market in addition to having AI and other tools that, by the way, we can use against them as well. But Wall Street's always got the upper hand. They are the market. They are the market makers. So you always have to respect that. You always have to take the news that you hear on TV with a grain of salt because sometimes it's paid for by advertisers that want an agenda to be put into your head to fulfill their agenda because it'll make you do things that might be unwise or unproductive to your portfolio or to your retirement income or to those things that are important to you. So the way we plan is we don't care what the news says and we don't care what the market does because you have your income needs taken care of, you have guaranteed assets, you have principal protected things, you have tax savings and tax strategies in place, so you're not going to get hammered with taxes if something happens. And you're going to see a beautiful picture of your future and what's guaranteed, what's predictable, and what are those things that give you the confidence in retirement, regardless of what the buzz is on the news from day to day or what happens over the weekend. We have this 3-day weekend last week, and all of a sudden the market freaks out and it opens down, even though the prior week it started out a little sluggish, but ended on a strong note. And then all of a sudden we're coming up with some excuses on the news for why it's weak and why, something's happened that makes the market not be a wise place to put money anymore. But again, it's all just kind of advertising. It's all cheerleading or opposite of that, but it's to manipulate the public into doing things that they shouldn't do. I just read a stat, and I've read this several times, but a very high number. 93% of people that invest in the stock market and do it on their own, try to trade and get manipulated out of money, they lose money. Wall Street probably never loses money. They pretend they do, but even in a seller's market, they're buying low and they're getting transaction cost, the difference between the bid and the ask price every time there's a transaction. Even if there's sellers, if there's high volume, Wall Street wins. They don't care if their inventory goes down. They're just going to buy more cheap because they've been hoarding cash. And if we look at what smart money's doing and do the same, we'll probably be right more often than we'll be wrong. Right now, there's a lot of hedge funds and smart people hoarding cash, even going to bonds, which haven't really been that great the last couple of years. Moments here and there that the bond market looks like it's strengthening because interest rates are supposedly going down, but they're really not. Mortgages are supposedly going down, but they don't seem to be really doing too much. Try to get a loan on a car nowadays. It's outrageous, compared to what we were borrowing money out a few years ago. But it's probably realistic compared to what we were borrowing 10 years ago or 20 years ago. But things change. You have to take care of you. Don't bet on the market looking after your best interest. It doesn't. The market does what the market does. So I guess we come back to how do you not listen to the noise or how do you not let what's on the news bother you? Is you have a plan that keeps you secure no matter what that news is and no matter what the market does. Again, I'm not saying don't be in the market. I mean, we did phenomenally well last year in the market, beat the market. Our blended portfolio, even with the safe stuff, beat the market. So we can navigate through these times. That doesn't mean we're going to do it continually. It doesn't mean we're going to continue to beat the market forever. It doesn't mean we can't lose money, but that's why we only allow people, at least our clients, are only allowed to put money in the market that they can afford to lose. That's over and above what they need to spend on a monthly basis. I mean, if they're taking monthly money out of that account, we're not going to put it in growth and risk. Sorry, you have to find another advisor if you want all your money at growth and risk if you're using it for a monthly basis. Unless you're using a pittance of it and you've got $4 million, you're only using like maybe $20,000 a year or a couple thousand a month out of it. That's not a big deal. But I have clients that, want to live on a 10% withdrawal rate out of a stock and bond portfolio that has been averaging that the last few years, but with a couple of big crashes mixed into a retirement decade or two, that person's going to run out of money if they're living on that big of a withdrawal rate. So I think people have a little bit misunderstanding as far as what average returns and the sequence of returns do to a portfolio. And that's where we come in, is to try to guide them and help people understand that there is a difference. And just because you get to a place in life where you get to retire doesn't mean you use the same strategies through that retirement. Interestingly, I don't agree with a lot of things that Dave Ramsey says. I happened to go to a meeting in Florida last week that keynote speaker was Dave Ramsey. He does all the things, I think, in his mind for the right reason. And I think if you want to get rich for retirement, you do the things that he says. Live within your means. Don't get into debt. Those are all very wise counsel. However, buying a growth mutual fund in retirement, if you back test that same plan, this famous financial guru who got out of debt himself and is touting the things that he's learned over his life is great. And I hope all young people listen to that. But when you get into retirement, you kind of need to have already graduated from that strategy, and you need to start looking for protection, asset protection. Some people think just because the rate of return on a fixed indexed annuity averages 6 or 8, it never loses money. You can pull more money out of that than a volatile stock investment that has 20% or better years like some growth funds do. And that's just a fact. It's a statistical fact. It's a math fact. Math always proves you right or wrong. You can have whatever opinion you want, but the market will prove you right or wrong, and so will math. And if you look at history and you look at math and you look at the volatility of the market, and the fact is that the returns are not equal every year, even though they average a certain amount, they are random. And the randomness of returns kills retirement plans, and people need to realize that. So once you get past that, I've saved enough, let's get into protecting it. Protect it first, and then worry about risk second. And if you can handle the risk, then again, watch the news with interest and with excitement, but don't let it get you depressed, and don't let it make you feel like maybe you're not going to make it through retirement.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about current events and particularly the market. If you'd like to preserve your wealth, maybe create an income stream that you can't outlive, reduce taxes, and more, call us here at Premier Retirement and request your Premier Retirement Roadmap. It's a casual conversation with Jeff here at no cost and no obligation. The number to call to get yours, 520-780-9059. It's 520-780-9059. Chance for you to sit down one-on-one with Jeff and ask the questions that you need to put you on a path towards a confident retirement. Okay, Jeff, let's continue our program today by talking about the old 60-40 stock-bond split. Is it dead or just misunderstood? For decades, Jeff, 60-40, that portfolio, 60% stocks, 40% bonds, it was considered the gold standard. What worked so well about it in the past, and why is it just not as applicable today?
Well, for 40 years, the bond market has basically gone up because interest rates over those 40 years have slowly gone down from about 6% down to about 0 just a couple years ago. But in the last couple of years, interest rates have gone up, which makes the bond prices go down. We've seen 20-year bonds go down 20 to 30% in value. So if you've got 40% of your money riding down 30% over the last 3 years, you're losing about 10% per year. And that's like on a 20-year bond portfolio, an ETF, a TLT, you can look it up. It's bounced a little bit. It's gone up last year a bit, but it's still down from when it peaked out a few years ago. So that's going to put a drag on the gains in the stock market. It used to be that the stock market would go up, interest rates would go down, which meant bonds went up in price, because if interest rates are 5% and you have a 6% bond, guess what? You get a premium on that bond for the interest that you're going to make over the next 5, 10, or 20 years. So the price of bonds has gone up, interest rates go down, which makes borrowing easier for companies, especially the tech companies, which borrow a lot of money, and their stock goes up. So you get the stock and the bond market going up together. It used to be that you bought bonds because they were the stable force when the stock market went down. Well, now if the stock market goes down, they might have been a little bit more stable, but lately they haven't been. So let's say you lost 25% in the stock market in 2022 when the Biden inflation years hit us upside the head, and the bonds went down too. So the bonds are still down 30, stock market went down about 20, took about 2.5 years. So now the market's up about 30. So I see all kinds of people that 3 years ago, if they haven't added money to their portfolio, even if they haven't used very much of it, that 60-40 portfolio is still not much more than break even. And they're upset like, well, the market's up like 20 the last few years. And back in the COVID years, I got my portfolio up to $2 million and now it's only 1.9. How come? I said, well, have you been using money? No. Well, the bond market dragged. And when the stock market goes down 25% on 60% of that $2 million, you're looking at maybe a $400,000 decrease that has to be made up in stock gains. So the stock market has bounced back. The bond market is still kind of meandering down where it was. And, if you look at that over a period of what could be 30 years, now it could happen that the interest rates go down again and those bond prices go back up a little bit. But if interest rates go down, it's usually because there's a recession and maybe the earnings are not supporting the stock market. So we might have a stock market correction to offset it. So again, stock and bonds both have risk. They're all risk assets. Don't think that one is safe. The only way to make bonds safe is to buy those products that are supported by bonds, but somebody else takes the risk on the profit or loss on those bonds. And that's why we put our bond allocation into indexed annuities mostly and to LIRPs, life insurance products, because the insurance company will buy those bonds. They keep them forever. They don't care if the market's going up or down because they're not selling bonds. They've got billions and billions, and some companies even over $1 trillion in bond holdings in order to support all their investments. And what they do is they take the interest that they're making on bonds. If they bought a bond 10 years ago and are making 4%, guess what? They're still making 4% on that bond. They're not risking the principal. They're only risking the interest, and they're investing that interest. They're buying options on that interest. They're doing maybe risky things with the interest, but they're never risking the principal. So if they do risky things with the interest and they're institutions that know what they're doing, they might be able to make that 4% bond yield 8 or 9%. Well, if they can yield 8 or 9% and still take their 1 or 2 off the top for their trouble and let you make 6 or 7% on that portfolio instead of 4 minus their fee or the fee that you paid to your advisor, maybe it's 1%, whether it be a mutual fund or advisory fee, it's probably 1% is probably a normal figure. Maybe it's higher, 1.5, sometimes even 2 I've seen, but let's just say 1. If you're losing 1% on a 4% bond portfolio, I mean, you're still only netting out 3. You can do better on a CD, at least right now, in the stock market as well. But what if that indexed annuity, the fees are built into the profits to the company? Maybe there isn't a fee. Some companies have fees, especially companies that give you bonuses and some of these kind of bell and whistle things to make you want to buy annuities. And they're not always good. We could do a whole hour on what's good and bad about bonuses on annuities. They're very often not even real bonuses. They're kind of fake bonuses. But anyway, depending on how these annuity companies and these insurance companies invest your money, they make a certain amount on your money and they will keep your principal safe. The cool thing is because they're not selling their principal, they're only investing the interest, they can still secure your principal so it doesn't go down. I would rather have a bond portfolio from 4 years ago, even if it only made 1 or 2%, even on an index annuity that just underperformed, your principal is still intact. Whereas if you were to buy that 20-year bond portfolio that I talked about, that's going to be severely down. To paraphrase, if you look at just 5 years ago, that the 20-year Treasury bond price for that ETF was $156. That's where it peaked out, about 2022, right before the market crashed. You know what it is right now? It's almost at its 5-year low, and it's at $87. So we've lost more than a third of your value on that policy, yet some of the insurance companies invested 5 years ago your money at that rate. So if you're not down at all, even if you could surrender that policy and lose 10%, guess what? You're better than your bond allocation. So why would you put money in a risky environment where bonds can lose 20 or 30% in 2 or 3 years rather than say, I'm going to put it in something that I can't lose any money? And some people say, yeah, but isn't there a penalty if you pull it out? Well, then don't pull it out. And if you do have access to 10 or 15 or 20 or even 30% of it, some have more liquidity than others, you can still get your money out over a period of time or after a 5, 7, or a 10-year period, 12 years in some cases of a surrender period. Maybe the most you lose is 10%. That's certainly better than 30% in a bond portfolio. So in my opinion, since the index products and the principal protected products from insurance companies, and by the way, that works the same in a LIRP, life insurance retirement plan, you might pay for the cost of insurance to play the game. You have to buy a little bit of insurance to play this game, but you can stuff a whole bunch of money in a tax-free bucket that still grows at 6 or 8%. And we had clients making 15 and close to 20 last year on something that's principal protected. And it's locking those values in on an annual basis. They don't go down. Even if the insurance company is down 20 or 30%, it may look bad for them, but they've got tons of surplus. They've got tons of extra money that is liquid. They can continue to pay you what they've guaranteed to pay you as long as everybody on the planet that has an insurance policy with that company doesn't die in the same year. And that hasn't ever happened. Your money's secure. And if it isn't, there's still guarantee funds, there's still surplus, and there's all kinds of money that backs it. So I like to play the bond market safe because it's one area of risk that I can take completely out of risk and use those other products. Now, Wall Street hates it. Honestly, I make a lot less money over the same 10 or 12 year period that you own an annuity than I make on managed money, a lot less. So does Wall Street. That's why they don't lock in. But it's funny because they'll tout, oh my gosh, they make huge money, annuities have big fees, and oh my gosh, your guys who sells them are killing it. Well, you know what? You know why we kill it is because when we use annuities for our clients, even if we make less over the same period of time on a commission-based product or something where the company pays us a trail, we get to choose how we get paid, by the way. It doesn't even affect the way your product works. It's just built into the profit or losses of the company's business model. But based on that, the way that we do better by using those annuities is that people are confident, they stay longer. So the amount that we do manage on a fee base stays with us for a long, long time. We don't have that turnover rate of 20% turnover, like 1 out of every 5 years, somebody changes advisors because they're not happy with something, or they forget to call them, or the performance isn't as good, or they never heard about the principal protected products that they could have used and they never gave them any tax advice or whatever. There's 100 reasons why people would change advisors, not just for lack of performance, but when you're not using comprehensive planning, when you're not using those things that give you the stability and confidence in retirement, people aren't happy. They're going to want to look elsewhere for other options. But we believe, and our model certainly shows it, that over the last 30 years, we've sought out safety first for our clients, principal protection for our clients, guaranteed income for our clients with a tax efficient payout where you're paying taxes maybe on half of your total income if you do it right. We have tons of clients we can show you that have done it, and we can show you how to do it. It might cost you a little bit of pain up front for a few years, but if you get past that and you can live close to tax-free or very limited taxes ongoing for the rest of those 2 or 3 decades that you're going to retire, you'll be way better off. When we add all that stuff and make you happy, guess what? You stick around, and those annuities are what makes you sleep at night. It makes you confident that you won't run out of money. You know you're going to have it gives you the peace of mind that you know you're going to have a paycheck next month. That'll pay all your bills. You can adjust and tweak from there.
So, Jeff, if the 60-40 stock bond split is not dead, it's just misunderstood, what does real diversification look like here in 2026?
Well, in my opinion, we've said this all along, it's not just 2026. It's been, our business model for 20 years. And that is, there's 2 types of money. There's the money that's risky and there's money that's not risky. And I just explained in the last, 10 minutes or so, that bonds are risk assets. So let's dial your risk assets back, maybe to the 40%. Stocks and bonds, 40%, maybe all stocks. Maybe the other 60 is split up between LIRPs, life insurance, a version of a fixed index type of annuity, and a fixed index annuity that gives you income. Let's say you have $1 million or 2. Let's just say $1 million just for a round number. So let's say that $1 million, you put $400,000 into a stock portfolio that you can be a little aggressive in. You put $300,000 each in a LIRP and into another index type product that goes up when the market goes up, doesn't go down when the market goes down, averages maybe 6 or 8% is conservative. It may do better than that. Some of them have been doing better than that lately. But let's just say 6 or 8% on something that is principal protected is certainly better than you can get on a CD or a bond portfolio. Then you've got the LIRPs, also pays that, but it gives you tax-free income. So let's say between the LIRP and the index annuity, you can get $50,000 in income and only pay tax on half of it. $25,000 of it's taxable. The other $400,000 is in the market, and depending on what you sell and when, you may get capital gains treatment, or you'll get a little bit of income taxes perhaps on that. Or if it's in an IRA, you can convert that over time to a Roth and never pay tax on it and still get that upside. Maybe on that $1 million, you're only paying tax on $2,500 a month, or maybe $25,000 or $30,000. So I guess my point is not just principal protection, and it's also allocation between safe and not safe, income producing and tax efficient savings assets all combined. And I've just showed 3 basic ones. I mean, we have private equity offerings. We have other type of notes. I mean, you could buy debt. You can actually do some real estate lending. We have private equity groups that provide those type of things as well. But again, that is either risky or it's guaranteed depending on how the model is set up. Again, look at your risk levels, look at what you need for income, get that first, whatever's left, put at risk, and go ahead and swing for the fences if you feel like it.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And if you're still relying on the old 60-40 stock bond portfolio, you're not sure how your investments are really positioned for retirement. This is exactly why Premier Retirement is offering a modern portfolio redesign. It's part of the Premier Retirement Roadmap. You can get a second opinion on how your investments are diversified, how much risk you're really taking, and whether your portfolio is built for income, not just growth. To get yours, call 520-780-9059. No cost, no obligation. You can also visit us online at premret.com. That's 520-780-9059. Jeff, time for a break. When we come back here on Premier Retirement, we'll answer listener questions. And then finally, are you on track for tax savings in 2026? All that and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
Thanks so much for making us part of your weekend. You're listening to Premier Retirement right here on 790 KNST, Tucson's most stimulating talk. My name is Jeff Shade, of course, joined by Jeff Hogan of Premier Retirement Planning and Wealth Management. Hope you've enjoyed the show today. We're on the air for you in the weekend 4 times a week. Of course, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and then on Sundays at 11 a.m. And as always, we're also a podcast. Go to wherever you get those podcasts and search for Premier Retirement with Jeff Hogan. You're going to find this show and all of our past shows so you can see on top of your journey towards a confident and hopefully a prosperous retirement. Our phone number 520-780-9059. If you hear anything in the radio program today, you'd like to sit down, have an individual conversation with Jeff about your particular needs and wants, you can certainly get that by calling that number at 520-780-9059. There is no cost and there is no obligation. Jeff, time for listener questions. We'll start off with Jerry in Tucson. Jerry says, I'm 71 years old with $3 million in assets and still working. I earn about $250,000 a year. I'm wondering if it's time to retire. How do I know if I can safely stop working, and what should I be considering in terms of lifestyle, taxes, and investment allocation?
Well, Jerry, it sounds good. You're 71 years old. You're still working. I think when you're pushing your early to mid 60s, if you have 10 times your income in savings and retirement assets, so if you've got about $3 million in assets, I don't know if that includes $1 million home or not. Maybe it does, maybe it doesn't. I guess you can still consider that an asset. But let's just say your $3 million is investable assets, maybe a couple million in IRAs, 401ks, another million in stocks, bonds, cash, other things. Outside of that, to maintain that lifestyle is not hard to do if you put, let's say, 2/3 of it into something that's reasonably safe, protected, and provides income. So let's just say you went third, let's see, 71. You might be kind of pushing the limits on the LERP type things because it requires some underwriting. But, if you're healthy, you might even look at that. But let's just say you used index products that offer income. You could generate about $160,000, $170,000 a year from just something that would guarantee income. You've got Social Security on top of that. And right now, if you're making about $250,000 a year, you're probably having at least $50,000 in withholdings between taxes, Social Security, and other things. So you're probably maxing it out at $200 spendable, and you're probably saving $30,000 or $40,000 of that. So I'll bet you're living on $150,000 to $160,000. You can guarantee that kind of income easily on just 2/3 of what you've retired, and that is without risk. Now, if you want to risk the $3 million in market, stocks, bonds, the 4% rule is kind of the rule of thumb that's been used for years. But it's been debunked. It's already less than 4. But let's just say you're a good investor. The market never really has a massive correction. Well, I don't know. If you live to 100, you got 3 decades to bet against the market correction. I bet you lose that bet. But let's just say the $3 million and you take 4% out. That's about $120,000 a year. If the market continues to do good, you can kind of get a little increase. But with 2/3 of your money, you could do probably 30 to 50% more in income than the 4% rule, and guarantee that for life no matter what, and still have growth on that asset potentially. And if it doesn't grow, the markets don't perform, the indexes don't really do as well as we hoped they would. We go into a lull, kind of like the last decade of 2000 to 2010, which we're probably due for actually. Based on the valuation of the market, it wouldn't surprise me. We might get through the next few years with our current president, but when the next one comes in and decides to raise taxes and get us out of the deficit, or doesn't understand business and understands raising taxes to pay the budget rather than lowering them is a focus, you might find out that the markets don't perform. And what I'm talking about may not happen now, but it might happen in a few years. You want to make sure that that income piece is already turned on, that you don't have to say, oh, whoops, my $3 million just became $2 million. Now what? oh my gosh, I've got to use it all for income to make this up and I have no liquidity. So I would take that liquidity. I'd rather have a couple $1 million generating cash flow to keep you where you're at if that's a comfortable lifestyle for you. And I'd rather have $1 million that you could stick in the market. And if the market did collapse 40%, you've still got 600,000, you're not using it, and you could wait for it to get back to $1 million in a few years. Or you could even diversify that into less risky assets too, if you want to. Now, if you have a good manager, like we try to be, and is watching the market for you, we can see trends, and we might not ride the market all the way down 40%. We'll probably bail when it's only down less than that and maybe save some of those losses and get back in when the market turns. But again, nobody can time it perfectly. We can look at the markets. We can try to make decisions. But guess what? If we get it wrong on 3 million, that busts up your retirement. If we get it wrong on 1 million, well, you're still good. And you're still, retiring with a confidence. You're still retired on your terms. You're not looking for a new advisor because you've got everything intact and you're okay. Every day you wake up, you're okay. And what'll happen is you'll probably live a long life because you're not stressing out like all your friends are when the markets collapse and they wonder about how they're going to deal with running out of money or having to move back in with their kids or take a mortgage out on their house or reverse mortgage their house or sell their house and downsize and do all those things that so many retirees end up having to do when markets turn bad and when they've got everything at risk. So I think you're in great shape to retire if you want to continue to live the lifestyle you're living right now.
Jerry, thanks for that question. And of course, we'll send you out Jeff's book, Retirement, The Road Ahead. If you'd like to talk to Jeff, 520-780-9059. Congratulations, $250 is a pretty healthy income. Okay, Ron's in Marana, and Ron has a similar question, Jeff. I have a mortgage and other monthly obligations, and I'm approaching retirement. I used to think that my expenses would go down when I retired, but now I'm not so sure. How can I realistically estimate what my costs are going to be, and how should that affect my retirement timing and my saving strategy?
Well, you have to develop your avatar in retirement. What is your perfect retirement plan? Is it traveling the world in first class and golfing every golf course you can? That's an expensive habit. Is it gardening? It's a very cheap habit. How much do seeds cost? You can stay home. You don't travel. Figure that out. Write your bucket list out. What's your retirement look like? Who are you going to be? Are you going to sit back, live on Social Security, not need any savings, just volunteer down at the food bank in the church and do service and give back to the community and not worry about money? I mean, some people, that's totally fine and that's totally okay. Other people say, man, I work so much, I just really need to get travel, golf, and all these expensive things out of my system, and it's going to cost me a lot of money. If that's the case, then that's a price tag. So you've got to come up with that budget. I'm not going to tell you, oh, well, you can only spend this much in retirement, and a third of your money has to go to fun and traveling and these things, and this much has to go to emergencies. I can tell you that every client I have, and I've worked thousands of plans over the years, and I don't have two clients that are exactly the same. Everybody's got kind of a different deal. Some people spend all their money on travel. Some people spend all their money on a big house, kind of living their own resort lifestyle. Some people would rather have 3 townhouses in 3 different cities, depending on the climate, and the beach house, mountain house, and a Tucson house. And that really comes up to you once you figure out what your lifestyle is. Now, I can take your investments in your portfolio and I can tell you and do the best tax plan I can and save as much in taxes, guarantee the most income I can. And I can tell you, based on what you have now and based on you working X amount more years, this is a reliable expectation of income. This is how much is guaranteed, whether by Social Security or by annuities that have 3 or 4 levels of guarantees and safety, some that is more predictable than the stock market type income. And then we can add a little bit what if income from the stock market. Let that be your discretionary money, your fund money. And when the market does good, you get to ride first class on the plane. When it's doing bad, you don't, but you still get to go to Europe. It's still part of the budget. That kind of a thing. But I can develop a plan and say, this is kind of your max safe income to look forward to. And then maybe you build your budget around that. I've had people come in and say, well, this is what I want to do. And I said, well, this income plan might make you 120, but to do what you want to do, you need 150 spendable every year. You need to work 5 more years. You need to save a little bit more, have a few years left to live and spend, and a few more years to save and grow what you can grow. And some assets, if you start now, will grow at a guarantee of 9 or 10% of interest rate if you're going to use it for income later. So regardless of what the market does, you can start now or before retirement and pick a date and know pretty close to what you're going to be able to live on going forward at that retirement year. And that's why we do the retirement roadmap. We say, okay, when can we retire? If we retire now, this is the income. If we retire in 5 years, this is the income. Would you rather have an extra 5 years to spend money and it looks like you'll be okay? Or you're going to be really tight. Maybe you just want to do the go-go years and be happy with that. And you're willing to dial it back when you're 70 or 80 and just kind of cruise into the final days of retirement or the no-go and the slow-go years. So It's really up to you. Some people want to think they're going to be traveling until they're 100 and they want to keep up with inflation and have increased spendability throughout their life. Some people want to front and load it really bad because they've got health concerns. They don't think they're going to live long enough to spend it anyway. Everybody's got their own idea. So bring your ideas and we'll put a plan together and then you decide if you can or can't.
Ron, thanks for listening to us in Marana. And once again, if you'd like to talk to Jeff in person, 520-780-9059. Jeff is just a phone call away. Okay, Jeff, let's move on to Scott, hearing us in Vail. And Scott says, I'm 66 and retired, debt-free, and have a significant portion of my assets in cash. Should I invest more in the stock market now, or is it too risky at my age? How should I balance risk and income when I'm no longer earning a paycheck?
Well, that's really part of what you have to decide. If you're retired and debt-free, you probably have a really low nut to crack as far as to eat and drink. You might be able to live just on Social Security for the food and gas, if that's all you have is bills. The rest of it is you've got a significant portion of assets in cash. What is that for? Is it for rainy day or just because you don't trust the market, you don't want to lose money and you just like having cash? Everybody's got kind of a different threshold of pain and a threshold of risk. I think you might be in a position where you could invest more in the stock market now. How much could you lose without getting sick? If you got $1 million and 800,000 is in cash, I think you're probably a little too heavy in cash. If you're debt-free, you've paid everything down and you don't have any savings, and you've got 100,000 left and it's all in cash, well, I understand why you might want to. Maybe you only want to put half of that money in an investment so that if the market goes down, you're not losing a significant amount of what could be emergency money and things like that. So I don't know your whole picture. I don't know what your bills are. I mean, you might have a massive house and a huge tax bill. That alone might be something you have to cover over and above food and gas. And you might actually still have a reasonably high lifestyle if you've got a lot of expenses that go to maintenance of those assets that you might have to maintain. If it's not just a paid off house, that doesn't mean, and I don't even know if you have a house. You just said you're debt free. You might be debt free, but renting. I don't know. We need more information to probably develop a coherent plan. But if you're even concerned or talking about, should I invest in the market or is it too risky at your age? I think it's probably really risky if you haven't been in the market and you're trying to get in for the first time. Just be prepared that the first experience you have, the first memorable experience you have in the market going into retirement might be a big crash. So it could also be great guns for the next couple of years and then a correction. I don't know. The fact is you have to be ready for all things that could happen in the market. And if you're not, then don't put it in the market. You can have index products that go up when the market goes up and don't go down when the market goes down. I really like them now more than probably ever because the market being so overvalued as it is, if the market were to correct, you don't lose any money on your assets. And when the market starts going up again, it resets to the new value of when the market's down. So you basically are buying low without losing money. You don't have to ride the market down. You're basically parking your money in a safe place and you're buying at each low point when the market corrects. You're also locking in gains if the market doesn't correct and continues to go up. So I don't know why more people don't do it other than the fact that Wall Street and your broker or manager or advisor over there doesn't want you in these because they either can't sell them or they don't make an ongoing fee on them. And it kind of messes with their business model, but it doesn't correlate with your retirement model. You need to do what's right for your retirement model and not care about what the business model says. So that's my take on it. Should you invest more in the market? Yeah, I don't know how much you have. I don't know how much you can afford to lose. Sounds to me like you're kind of risk adverse or you wouldn't have that much in cash. So maybe a little bit in the market, but you need to be ready for the risk.
Scott, we appreciate that question. Thanks for listening to us in Vail. And once again, you can contact Jeff at 520-780-9059. Sit down with him in person and get all your questions answered. If you have a question you'd like us to answer on the air, you can get it to us two ways. One of which is you can call it into Shelley, 520-780-9059. You can also go out to the website, primrat.com, and leave your question there in the contact page. We use it on the air. You'll not only get a great answer, but you also get Jeff's book, Retirement, The Road Ahead. You're listening to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management right here in Tucson. Jeff, January here upon us, and of course it is beginning to become tax season. Did you maximize your retirement contributions last year? You're on track for tax savings in 2026. Jeff, a lot of people think that retirement contributions are just a December issue. Why is late January such an important moment?
Well, I mean, January is just the first month into the new year where you have to start. I mean, by now, you know what your income was last year and you know whether or not you want to make additional contributions either to IRAs. Too late to convert to Roth. You have to do that before the end of the year, but you can still contribute. And some plans, if you're self-employed, I know will even let you do 401ks up until tax filing date, SEPs, personal pensions, that kind of thing. Most companies don't let you. They won't count it for last year, but there are some opportunities to do an IRA or spousal IRA. There's around $8,000 you can put into each of those for two spouses. Might get you another $15,000, $16,000 in tax deductible deferred income if you want to do it that way. You could also say, I'm going to add to a Roth. I just got this extra money. I'm in a decent tax bracket. Let's just put away as much as I can tax-free. You can do it right up at the time you file taxes because it's not necessarily April 15th. If you extend, you also have an extension on that time when you can contribute those assets to those accounts. Now, you may have to do the appropriate accounting, and there is some issues with accounting because if let's say you have a Fidelity account, which we use for a custodian on investments, if you put money in April 14th because you're going to file the next day, they're still going to count it as if it were a contribution for this year. So you have to make sure that you file it correctly. They're not going to audit you just because you took the deduction for last year. You just can't get the double deduction, obviously. You can't use it twice. You just have to pick the year that it's for. So between now and April is really the time to do, but January is the time you're going to start getting your 1099s. I get funds that come in. I do a pretty good job accounting. I'm pretty sure I know where they come from, but some of it is principal return, some of it's interest. Sometimes I need those 1099s at the end of January before I really know what I made last year to know whether or not I need another tax deduction or whether I can afford to put away some extra money into a Roth or even a non-deductible IRA and convert it to a Roth. So there's still some opportunities to tweak the tax plan. It's not huge opportunities. Typically, those you're going to need to do retroactively, unless you have some specialized defined benefit plan or something like that, and you're self-employed. You can do some tricks that way. But again, that's kind of a few and far between thing, not for the bulk of the public.
So, Jeff, let's be clear here. There are some things that people can do right now that will affect your taxes and will impact last year. So let's shift forward here. What can we do now to affect tax savings in 2026 and beyond?
Well, in addition to what I just mentioned, and as far as what we can do for last year, those contributions, you can also make plans to convert assets and do kind of a Roth conversion strategy where you convert, pay taxes now on less money that then you'll probably have in the future, assuming those assets go up, not down. You might be wise to do some Roth conversion strategies or to put extra money. If you're still a few years from retirement, you might have some opportunities to either fund a Roth or if you're in a higher tax bracket. We had a question earlier, guy's making $250 a year, he's 70, maybe he doesn't really use all that money because he has no debt by now and he's living on 100. Well, if he's got an extra 100, maybe you could either put that into, if you're already doing Roth conversions, or maybe you've already done a bunch of Roth conversions, you can add to LIRPs, life insurance retirement plans, where you can put money into them and it grows tax-free. You can borrow against it tax-free, so you never actually reduce the balance. You take the money out, the balance is reduced by the cost of insurance. And if you buy a minimal amount of insurance, then the costs are minimal. If you buy tons of insurance, which is really where the commission is and where most life insurance agents try to get you, is buy as much insurance for as little cost as possible, maximize the commissions, and you're going to end up having to either lose your insurance or pay more later. Unfortunately, that's what happens. We had a big case with Kyle Busch, the race car driver that put millions in, but he forgot to fund it, or, he blamed the rep. I don't know if it was sleazy by the rep or not, but they bought tons of insurance. And rather than putting $1 million in every year, he only put $1 million in once. And it was this huge policy. Didn't play out. He could have put $1 million in once and bought, $1.5 million worth of death benefit instead of 10 million or more. So again, be careful when you do invest in LIRPs. Make sure it's a tax plan and not just a legacy to make somebody else rich when you die or something that'll blow up because you underfund it and don't understand it. But we call the LIRPs the rich man's Roth. Rich people use it. They usually get advice from more skilled agents than the one that dealt with Kyle Busch, apparently. But I just bring that up because it is out there. If someone wants to read how not to do life insurance, all the blame's going to the agent, but I'm not sure that it necessarily should go all there. Probably the bulk because it wasn't followed up on, but it was mostly because the client didn't understand. It was either misled or misrepresented, or the agent didn't know what the heck they were doing, or the Bushes didn't understand what was required of them to make this thing work. So they work great if you use them right and fund them right. And if you don't overbuy insurance. But if you overbuy insurance, it just ends up being a great thing for the agent and a bad thing for the client. We like to make it a great thing for the client. We get well taken care of anyway. But the options are you can invest. And by the way, as a financial advisor, we're in business and we do make fees and stuff. And, if you're a fee weenie, then do it yourself and good luck. But when it comes to those costs, find out where those costs are coming. Are we limiting the costs out of pocket for you? Or are we, as advisors, looking out after our best interests? As a fiduciary, we're supposed to look after your best interest. And if we do that and do it for the right reasons, we all do well. You do well, it's your money. You should keep it that way. It's your money. You should be the one that makes the bulk of it. But make no mistake, there's cost to everything. Understand the fees and understand how it gets paid. Everything we do, there's some sort of a compensation factor in there. Just make sure it's not bilking you out of the majority of the investment. Make sure that it's fair. Make sure that it's a win-win. And make sure you understand how the product pays so that you're not blindsided down the road and freak out later. So again, make sure that you look at all the options. Mostly it's really Roth conversions. There's also going forward, and how do you make those contributions? Do you have a 401k contribution at work that can be a Roth or not? Some companies do, some companies don't. Some companies say you can't use the match that we pay as a Roth, but your own money you can, but not ours. And so know the rules, know how to maximize your future tax bill. And when we build a plan, we throw 30 years or more on there, and we calculate based on current knowledge of tax code what your taxes should be. Now, sure, they could change, but all we can go on is what they are now. And if we can base our tax plan based on what we know the tax code to be currently, we'll make good decisions. If we save taxes now, or if we plan to save taxes in the future by doing things now, then you don't have to worry about how much taxes are going to be charged to you when you decide to plan later. We at least know the worst case scenario, and if it works now, it will have already worked, and at least your taxable money, more of your taxable money is off the table by the time you find out the tax code changes.
So basically, Jeff, waiting until December limits your choices, but planning right now in January is going to expand those choices. So bottom line, Jeff, January isn't the start of a new year. It's a chance to, I guess, really get ahead, isn't it?
Well, it is, but it's the start of a new year. I mean, we can still do stuff in December, but I think that January is a great time to reflect and say, what can I do to make sure I did everything I could last year? There's a couple of things still left open. There's not a lot. You should have done it before. And I think if you're looking at the future, January is a great month to reflect what you did in the past and make those changes so that you don't have to wait to December and do last minute changes. You can do them along the way. If you think the market's going to go up this year, it'd be better to do a Roth conversion in January than it would be to do it in December at the end of the year, when that $200,000 Roth conversion you were going to do right now is $300,000 because you had a really good year. And that might be a little excessive on the earnings, but what if it goes up to even $330,000? Now you have to pay tax on all the gains too when you pull that money out and do the conversion. Wouldn't it be better to do the conversion, pay tax on $200,000, and then have all those gains in that account between now and the end of the year to be tax free? So it is, in a way, a great time to reflect on last year and do whatever tweaks are available. But it's a better idea to estimate this year, estimate future years, and build a plan where you can make the most tax efficient income for the next 30 years, but do it over maybe the next few.
Great conversation today, Jeff. I want to take just a moment here to talk to our listeners. Are you absolutely sure that you've maximized your retirement contributions last year and that you're positioned for the best tax savings going forward? Most people aren't. The window to fix missed opportunities closing, and once tax season is over, those dollars are gone for good. Jeff Ogan and the team at Premier Retirement Planning and Wealth Management are offering a complimentary retirement and tax strategy review to help you identify what you may be able to do right now and how to reduce taxes in 2026 and beyond. Don't guess, get clarity. Visit primrat.com or call 520-780-9059 and request your consultation with Jeff. There is no cost and no obligation for this. 520-780-9059. Ask for your retirement roadmap. You can also get it by going to primrat.com. Jeff, out of time for this week. I want to thank you so much for your time, but most importantly, I want to thank the greatest listeners in the world, ours right here in the greater Tucson area. So for Jeff Ogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona State registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.